Hello traders, welcome to today's video, and I think it's appropriate that we address the slightly inappropriately placed bear in the room behind me. We are going to talk bear markets, okay? Now, I'm by no means saying that we are going to enter into a multi-year crypto winter or anything like that, or that prices are just going to go down, 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 down forever. I'm talking about these phases of consolidation that you have after a major correction in price, and that does appear to be where we are right now on the charts. Okay, so anyone who has been following price action recently, or if you are watching this video up to date as well, you'll be well aware that both crypto and stocks have taken quite a tumble over the last few weeks. So we're going to cover basically the massive opportunities that this does provide. And in my opinion, this is where the real wealth is made. So of course, with any of my videos, there is no financial advice within this video at all. I'm not a financial advisor. None of this is meant as financial advice. You must do your own research. But this is my own opinion, things that have worked for me in the past, and hopefully some people can take some maybe useful information out of it. So for me, these big consolidation periods are my favorite times. They're the times in which you can relax, you can really focus on your edge as a trader, and you can focus on basically doing the work that most people are unprepared to do in order to make them capitalize when things start to get a little bit crazy and hyped up again. Okay, so bear markets, they're not easy. They require patience, discipline, and dedication, but they also provide the best opportunity for making life-changing money. So then I've got a little question here. Okay, so why is it that most traders never make it, even if they have been around for multiple cycles? And we see this all the time. Okay, we see people who have been around for since 2014, 2016, 2017, 2018, etc. And even for those of you who have entered into the last kind of bull run, why have these people not made it, and why are they still living the same lives, still trying to find a way to find an edge over this market and to basically make money, which is the reason that we're all here? I think it's very simple, really. Okay, and it goes into this cycle that a lot of human beings, just generally the kind of psychology that we have, we get caught up into this cycle. So they get drawn into the hype and they get overexposed at the highs. So of course, through a lot of last year, last spring, last kind of towards the end of last year, things were very, very bullish, right? There were a lot of people talking about crypto. There was good news coming out all over the place. There was a lot of hype. There were all these new projects launching. There were people talking about, oh, this coin's going to have this utility, all these NFTs and all of that kind of stuff. So there's so much to talk about. There's so many people willing to talk about it. And you could get drawn into that hype and you start to believe that price is just going to go up and up and up, and we're going to hit these 100Ks, this $1 million or whatever it is, what targets you had, that is very easy to get drawn into. And it happens to everyone. Like, everyone likes bullish prices, everyone has high targets, and we see time and time again that crypto does go pretty crazy. When it wants to be bullish, it can go very, very high, but then you get the downside as well. Okay, so a lot of people, they get drawn into that hype and they get overexposed. So it's okay to be in there at the hype, but it's not okay to be overexposed. So they end up buying, believing that price is going to go up, where really there's not that much space left for it kind of towards the end of the cycle. And what happens when you get these corrections? Okay, they've maybe been buying right up at all-time highs when everyone's talking about it, and then price starts to come down. Okay, they get impatient, they get frustrated on the correction, and then they make bad decisions on the way down, whether that's trying to buy every single dip until the point in which they have no money left, or whether it's just being frustrated and annoyed that you bought high and now you're sitting at a loss. It's one of those things. So then we enter into this phase of the bear market, or phase of the market, which most people do not participate in. And this is because they get bored, they stop taking interest when the real opportunities are there. So you'll see, again, if you were to talk to anyone about crypto in, say, late 2018, 2019, they probably wouldn't have really wanted to listen. Okay, we were sat there like, what, $3,000 or something, after being at $20,000. Even people who had maybe bought up at 18, 20K or even 10, 12K or something, they're probably not interested when price goes down to those lower targets. I mean, it's kind of boring. Price is just going sideways. There's not a lot going on. Unless you're really kind of focused on the market, it would be natural to think that, oh, it's all over, it's not going to come back. That was just a one-off event, and yeah, you're never really going to have that opportunity again. So people tend to just, yeah, get bored, stop taking an interest. But for me, that is the time where you, as a trader or an investor, is where the huge opportunity is. Okay, crypto's not going anywhere. The stock market's not going anywhere. And if you're focused and you're kind of showing that same level of interest that you would do where there is all this hype, so as long as you keep that same level of interest up when there is hype, and you keep that going through these kind of boring periods of the market, then that's where massive opportunity is there to be made. Okay, so that's just a little kind of introduction to all of this. So use the boring periods of time to master your craft. This is your biggest opportunity. Okay, so the four things that you can do that are really useful during this is to learn technical analysis, or if you already know technical analysis, get better at it. You've got a period of time now where things aren't going to be moving and going crazy all over the place. Okay, they might do, but if we are entering into a bear market phase, you're going to have relative calm across the market and slightly lower volatility starting to come in again. So it's a great time to learn something like technical analysis. Practice your trading and work on your edge. So if there are things that have been working really well for you during the bull market and suddenly that's not working anymore, then work on that. Okay, you've got to find new ways to trade, new ways to make money in this market, and again, this gives you an opportunity to do so. You can also, if you're more of the kind of investor mindset, do your fundamental research to find the next big projects. Now that can be these kind of low cap hidden gems that no one else is talking about when we go through these kind of boring periods, or maybe it's projects that have had some hype in the past and are still doing really good development, but maybe they're back down to really good prices again, and you can start to accumulate or start to kind of do your research into these in order to take things further when kind of price starts going crazy again. And then also keep up to date with the news. Okay, so if we are going to get a catalyst for another expansion in price, there are going to be news events that go along with that, so keep up to date with the market in general. So those are four things that really, I'm sure the majority of people would have been doing that during the times when things were bullish, last spring, for example, 2018, for example. However, the vast majority of those, and again, this is why they never make it, they stop doing this stuff when things get boring and when you go through these periods of consolidation. So if you can keep that up, you're going to be able to make the most of these opportunities that are provided. So that's kind of the first step, and let's go through ways in which I tend to do things when we enter these periods. So first of all, I'll focus on trading. Okay, so a few tips for myself, again, no financial advice, on trading in a bear market. Okay, so do not chase every move. Okay, the problem with when things are crazy bullish, okay, things are moving really, really fast. There's always opportunity out there. When we enter these kind of calmer periods in the market, that's not really the case. Okay, moves will get retraced. You'll have fairly good balance across the market, so there's no need to chase. There's no need to kind of feel FOMO on any of this. And if people are struggling with the FOMO idea, I do have another video that's based on that, so maybe there'll be a link up here or something for that video. So do watch the video that I've made on FOMO if you do need to kind of go over that. So no need to chase every move. Secondly, focus on your entries. Okay, so during these kind of periods of the market, it's a lot less crowded. Okay, more often than not, it is the traders who are the professionals are going to be trading this, and other than that, it's a lot of bots and algos. The retail is not as active in the market as previously, so you got to focus on your entries because you may only get one chance. I mean, if a lot of the market is looking at a certain level, it's likely to hit that level, and then if you're either in it or you miss it. So you've got to be patient there, and you've got to focus on those entries. You've also got to be making sure that you're paying yourself regularly. Okay, so these trends are likely to be short-lived. We're going to be playing in mostly a range-bound environment if we go through one of these times in the market. and you've got to be paying yourself regularly. So know where to get in, focus on your entry, and then make sure you get an exit in profit. Okay, so you're just working on kind of getting a good kind of successful win rate out of this. Also, I'd say focus on a small number of assets. So again, everything's going crazy. You're in a mad bull run. There are thousands of assets. They're moving every day. Once we go into this kind of consolidation period, it becomes a lot easier to focus. All right. So maybe you just like to trade Bitcoin, and then you could trade maybe just one or two, a few other assets on the side, Ethereum, Link. You could trade the SPX, you could trade gold, but just focus on a few of them and know how they move. And then, of course, trade it both ways. So a lot of people who are coming out of a bull market will just be used to taking long positions. And if you are used to taking long positions, like I said in the previous slide, like work on your trading, find your edge, learn how to take short positions. Okay, it's a different mindset that is involved with taking short positions, but you've got to be able to do it if you are to trade effectively within a bear market or a period of consolidation. Okay, then typical trading patterns. So these are things that I find when we do enter into these kind of periods of the market. Okay, so price will spend more time in a range rather than trading. Now that's true of any market more or less all of the time, but during these times you will find that range trading is just what you find yourself in the vast majority of the time. Okay, so trends will be short-lived and breakouts will usually fail. So again, you're going to be spending most of your time in a range, and when you do have these trends, you've got to be able to kind of get out of them fairly quickly. It's unlikely that you'll be really kind of seeing any major breakouts. A lot of the time when you do come into these breakout areas, you can fade them, and then it's back into that kind of range style of trading. Order flow wins. Okay, so by this I mean that certain trading techniques that work really well during a bull market, you're looking at kind of a markup, a retracement, you take the next leg up, you're looking at a retracement. That works really well during these trending markets. But during these kind of more sideways times, order flow is very, very important. So it's very important that you do learn that. So to the untrained eye, charts can appear choppy, okay, levels being less respected. But this is where volume and delta based strategies often work the best. So if you can learn how to read volume, learn how to understand where the big money is entering and exiting the space, and where some of these algos and bots and all of that kind of stuff are entering and exiting the space, then that can really help to provide a good edge. So things like your point of control, your market profile, your footprint charts, VWAPs, stuff that are based on just general order flow, start to become very, very important. Although they always are very important, but they seem to take even more of a kind of, they come to the front even more during these kind of sideways movements. And then of course you've got to be prepared for short squeezes and stop runs. Okay, so what happens very early into these consolidation times is you get a lot of people who maybe had been used to just prices going up, and then they see prices going down, 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 down. Towards the end, you have a weird change of behavior in the market where people who have been trying to buy every dip, suddenly they're really keen to short it. Okay, they're thinking, oh, well, if price has been going down this much and I've just been wrecked, then surely price can go down a lot further. And then you'll find that people tend to short very early. So this is why often the bounces, even at the beginning of one of these bear market phases, can be quite large. Okay, you do see these short squeezes that happen. So early shorts into a bear market times are often going to get squeezed. Okay, so you do see that change of behavior where people who are not used to shorting will suddenly try and take short positions. And then of course you've got to be aware of the stop runs as well. It's again, the aim of this is to bore as many people out of the market as possible. So you're going to be, or not bore as many people out, or just to get as many people out of the market as possible, to have open interest kind of going down. And so you've got to be aware of these stop runs as well. So hopefully that made sense. These are just some typical trading patterns that I do find during kind of these times of sideways markets. And then What the other thing that I tend to look at throughout these periods is preparing for the next big move. Okay, so this is more on a kind of, instead of trading, instead of like day trading like we were talking about just previously, this is more preparing for when the next trend starts to emerge. Okay, so we're thinking more of an investment type of thing here. So what I like to do with my own trading is to just, again, constantly kind of pay yourself as much as possible when when these markets, or when you're trading these markets, and then to start to put that profit into assets that you want to build positions in, ready for the next markup in price. Okay, so we're talking about this in this little slide. So start slow. There is no need to ape into every asset right away. Okay, so again, if you have been watching price recently, you'll know that we've just had a bounce off after a prolonged period of downtrend. So there's no need to get in straight away. Okay, you can be patient on this, and you have time to start to look at what projects you really want to be like building a portfolio in. So study the markets, find assets which show strength or reach macro support. So again, you're looking at things like throughout the last year, stuff like layer ones still showing relative strength compared to Bitcoin and compared to the rest of the market. So maybe those are things that you want to be looking at. Or, of course, anything that you think is a really good project moving forward that has gone back to its wave one support. So basically, where it started before this whole bull run happened last year, prices come back to where it started accumulating originally. And then you can start to think, okay, well, if it's done that before, this is good support. You can start to get interested in these coins again. Then diversify, but do not spread yourself too thin. So it is important that you are not just putting all of your eggs into one basket, and that always gets said, but don't spread yourself too thinly, okay? And this is an issue, again, that so many people have when we go through these really hyped up periods of time in the market, is that there's so much stuff out there that you end up finding that you buy just about everything. So be sensible with it. Buy the stuff that you think has kind of real potential, or the chart looks good. Of course, I come from a technical analysis kind of background all the time, so I'm always looking at the technical analysis. But from a fundamental perspective, just be focusing on the things that you really genuinely believe are going to do well in the future. So stuff that you don't mind holding. Okay. So spend the time doing fundamental research, find the next big opportunities. And this is really important because so many of these coins will, or so many of the things that have been pumping over the past year, are likely to go to zero, or are likely to never come back to prices that they had previously seen. So you do have to be careful, okay? You have to know a lot about the projects that you're investing into. You have to be confident in them, and you have to be prepared to take that risk, okay? They may go to zero, but it's entirely your own research, and this is why it's important to do good research and to understand what is important, and only be prepared. Of course, the old analogies of be prepared to put in what you're willing to lose on these kind of things. Regularly take profit and rebalance your portfolio. So during these, again, sideways markets, if you find that something starts to move up and away from the lows, it's generally a good idea to just shave a little bit off of that. Again, take profit as if it's a trade, because the chances are you're going to be coming back into this area and you're going to be forming an accumulation for quite a while. So there's no need to just hold straight away. You do have time to, okay, maybe you buy something at 20 cents, it goes up to 30 cents. You can take a little bit of profit off, knowing roughly that as long as you've done your technical research or technical analysis, knowing roughly that price is quite likely to come back down into that accumulation region of around 20 cents once again. And of course, finally, do not buy the pumps. So if you do see something moving, even if you really like it, don't buy into its, like, don't buy when prices are high. If you miss the chance, you've missed the chance. Wait for prices to come back down to an area that you have identified and an area that you are happy to buy, because the chances are it will come back down there. And just be patient. Okay, so don't buy into these pumps because again, we're in the bear market potentially, and if you are in a bear market, it's unlikely to get massive continuation. And then at some point, okay, we do need to talk about when you do go from this bear market back into a trend. So at that point, and hopefully this kind of makes sense. So we're talking about this being the period of accumulation. And then once that period of accumulation is over, this is that final phase and where, like I say, the big opportunity is. So you're looking to accumulate in DCA, and then once the trend starts to establish itself, once you are confident that there has been a decent enough period of accumulation and that the bear market is over, you want to be able to hold that. Okay, so often you'll find that people will buy decent areas, but as soon as price starts to go up, they almost don't believe it. Okay, it's like they're so used to price going sideways or price going down that when it starts to go up again, a lot of people close out those positions so early on. So it's very important to allow when a trend does start to emerge, and it's relatively easy to see, okay, because if you're in a range bound market, I mean, you're going to come up to the highs, you're going to try a breakout, and you'll come back down. Whereas if a trend does start to emerge, you're going to be holding above previous levels. You're going to be making those higher highs and higher lows. So when that starts to happen, just allow it to happen. Allow the market to take price where it wants to go, and then you can start to get these really big percentages out of it. Which is what I say on the last point here. So when a trend emerges after a prolonged consolidation, it often continues beyond projected targets. So we see this all the time, right? The bear markets and the sideways markets are pretty painful. They last for a long time. They get kind of boring. But then when things start to get bullish again, they often go a lot higher than what you would think. And you've seen this with just, well, name an asset that's been bullish. You've had it with so many. You've had it with Doge, Shiba, ADA, BNB, Sol, Luna, all of these kind of things. Like you would never have even, you couldn't even imagine the percentage moves that these coins have had over the past year or so, back when they were going through their accumulation. So if you're able to just ride that wave and wait for the market to tell you when it's coming up to a macro high, then it becomes a lot easier to make some really good money off of this. So I hope that's, yeah, I hope that kind of everything has made sense within this video. I know there's quite a lot of information in there, but I did want to pack this full of basically, yeah, things that I think are quite important when you are going through this time in the market. Hopefully this will help you with your trading and your investing, and yeah, I will see you on the next video. I think that's about it. Thank you. Bye.